Bonds used to be the go-to safe investment, but if you've looked at their performance recently, it's not so pretty. Are they even worth it anymore? Despite a rough stretch, bonds still potentially have an important role in your portfolio. I'm going to break down why they haven't performed, where they might fit in your portfolio, and when they might make sense for you. I'm Grady Cool, CEO of Cool Wealth Management. I help people make better investment decisions. Bonds used to be the smart man's investment. After the Roaring 20s came to a halting stop on October 29th, 1929, with stocks crashing over 12% in 24 hours, people lost a lot of trust in stocks. That was the beginning of the Great Depression, and it left an impression. After that, the safety of bonds was much preferred by the general public up until around the 1980s when stocks started to take off again. Interest rates were a lot higher over that period, so bonds paid a lot better. Interest rates started to come down throughout the 1990s and the 2000s till bonds paid what felt like nothing. When interest rates are sitting at 2 or 3%, it really makes you think, what's the point? There's been a lot of change-ups over the past few years. The pandemic sank the economy, the government did a ton of deficit spending to bring it back up, ton of inflation as a result of that, and some of the past as well. Then the Federal Reserve put interest rate hikes faster than any other time in history, and bond prices came crashing like a rock. When interest rates go up, the prices of bonds go down. Think of it like this. People want a higher interest rate that's now available, so they're willing to pay a little bit more to get it. Imagine you're a bond investor. You're getting 2% on your money for 2 decades, and now in 1 year, you've lost 20%. That's almost your entire return just gone. Now, why in the world is anybody investing in these things if you could get 8 to 10% a year with stocks, 5% in real estate, or 4% with cash equivalents, which is basically a savings account? There are 2 things we need to consider. For one, when interest rates come back down, bond prices will go back up a little bit. For those people who held on to their bonds throughout the interest rate hikes, they should make back some of their money as interest rates are cut back down, kind of neutralizing some of that massive change in prices. The other thing is what bonds are traditionally meant to do in an investment portfolio. Bonds are meant to provide a safe return that is a little bit higher than cash equivalents. Let's take a look at the hierarchy of returns for typical investment assets. At the top, we have stocks with around 8 to 10% a year on average. Below that, we have real estate and commodities like gold or silver, which tend to do a little bit better than inflation at around 5%. Then we have bonds, which pay a little bit closer to, say, 4%. Then we have cash equivalents, which is things like savings accounts, certificates of deposit, money market funds, etc. These are on average getting about, say, 3%. These numbers shift over time. It's just part of why, depending on how long you've lived, they can sound a little off, but the hierarchy typically stays the same. As you can see, bonds have a place, but they don't really make as much sense when all of the returns get compressed down so much when interest rates go down. The difference between bonds and cash equivalents just feels so small. At that point, you may as well just hold on to more cash equivalents and put a little bit more into the stock market. When do these things actually make sense for you? Before I dive into this, I want you to understand that bonds are never 100% explicitly required in a portfolio. But this is generally when I would give them a strong consideration. When you are approaching a part of your life where you need financial stability from the assets that you own, bonds are usually going to be part of the answer. This is usually retirement. Bonds are a better tool for holding value and providing consistent income than other assets throughout history. Stocks can crash hard, so if you have to sell them at a bad time, it can destroy your portfolio value. You can't take income from real estate unless you have rentals, and that's a job in of itself. Commodities like gold and silver keep pace with inflation, but they fluctuate in price like crazy at times, causing the same issue as something like stocks. And cash equivalents just don't have as high a return as bonds. Bonds are generally something you start to invest in as you start to approach retirement because it can take some time for them to build up. Compounding for bonds isn't nearly as fast as it is for something like stocks. For your average person wanting to retire around 65 to 70, this process usually starts around age 40s to 50s. You start with a higher percentage in stocks and then slowly a higher percentage into bonds over time as you get closer and then further and further into retirement. This happens as you have less time for the stock market to recover if it crashes. For example, Steve at age 40 might have 80% of his portfolio in stocks and 20% in his house. By age 50, he's 70% stock, 10% bonds, 20% house. Goes to age 60, it drops to 60% stock, 20% bonds, 20% in house. And then by the time he's ready to retire, it's dropped even further, where it's 50% in stock, 30% in bonds, and 20% in his house. You see the pattern. This should create a nice amount of diversification and stability while still being able to keep pace with inflation throughout retirement. The same concept of providing stability and income can be used for other purposes as well, such as trusts for children, education funding, or supporting a organization or endowment. You can try to create a similar effect with a large percentage in cash equivalents and a larger percentage in stocks. This only tends to work as a viable strategy if you hit a high enough size that you have enough cash to live off of during an entire market crash before things recover and you can sell at a better price. Selling then is used to refill your cash equivalents once you're in good times. If your portfolio is under $3 million, I would still generally be sticking to more of the bonds and stock strategy more so than the cash equivalents and stock strategy. There is flexibility. It's not just all one way or the other, but those are just my general thoughts. I don't think that bonds are as great of an investment as they were maybe decades ago, but I do think that they have a place in some people's portfolios. If you have questions, please let me know down in the comment section below. If you would like to work with me, feel free to check out the link in the description to schedule a 15-minute call going over the first step of a 3-part customized investment proposal free of any charge. Other than that, I hope you guys enjoyed and I will see you in the next one. Bye!